I tested over 50 different order blocks myself, trying to figure out one thing. Why do some order blocks react perfectly, while others get completely ignored by the market? And after spending hours going through charts, I started noticing something very important. The market does not respect every order block equally. Some setups are clean, sharp, and react instantly. Others look perfect at first, but completely fail the moment price touches them. And honestly, most traders lose money because they treat every order block the same. So in this video, I want to simplify what I learned from testing them, what actually makes an order block high probability, and the mistakes traders keep making without realizing it. First, let's keep this simple. An order block is basically the last candle before a strong, aggressive move in the market. That move matters because it shows real force from buyers or sellers. And this is where many traders already get it wrong. Not every candle is an order block. A strong order block usually creates displacement. Price moves away fast and leaves imbalance behind. That imbalance is important because it tells us the market moved aggressively from that area. Strong moves leave strong footprints. That's something I kept noticing again and again while testing. Another thing I realized is that the best order blocks usually break structure. They don't just create a small reaction, they actually shift the market. And that's a huge difference. Because if the zone didn't really change anything, there's less reason for the market to respect it later. Now here's something most traders misunderstand. Just because price breaks below an order block does not always mean the setup failed. A lot of the time, the market grabs liquidity first. Price dips below equal lows, takes stop losses, fills imbalance, and then finally moves in the real direction. This is why traders panic too early and get trapped constantly. After testing this deeply, I stopped focusing only on the order block itself and started paying attention to what's around it. Are there equal highs? Equal lows? Untouched imbalance? Liquidity sitting under support? Because the market loves liquidity. And once you understand that, order blocks start making much more sense. Another thing I noticed is that order blocks work much better in trending markets. If the market is clearly bullish, fresh bullish order blocks tend to react cleaner because buyers already control the market. But during consolidation or messy ranges, order blocks become less reliable because the market keeps moving both ways. Context matters a lot more than people think. And honestly, this changed my mindset completely. Instead of asking, "Is this an order block?" I started asking, "What is the market actually trying to do?" That single question improved my entries a lot. Freshness also matters. Fresh order blocks usually react better because the market conditions are still recent. When price takes too long to come back, new supply and demand zones form and the original order block can lose strength. Now let's talk about confirmations. This is another mistake traders make all the time. Most people enter immediately the moment price taps into an order block. Sometimes it works. Sometimes price completely destroys the zone. That's why I prefer waiting for confirmation on lower time frames. For example, if price taps into a bullish order block and starts creating higher highs and higher lows on the lower time frame, that can be a strong sign buyers are stepping in. That confirmation gives way more confidence instead of blindly hoping the setup works. And one final thing, even perfect-looking order blocks fail sometimes. No strategy wins every trade. That doesn't always mean your analysis was bad. Sometimes the market simply does what it wants. The goal is not perfection. The goal is finding behaviors and patterns that repeat consistently enough to give you an edge over time. And after testing order blocks myself, I realized trading is less about finding magical setups and more about understanding liquidity, structure, trend, and timing.